Good afternoon, everyone, and thank you so much for joining us for our final 2019 webinar, Health Spending Accounts, Canada's Best Kept Secret. Today's speaker, Ryan, is our Director of Group Retirement and Benefit Solutions with PPI Benefits, and we're so glad that you all could join us. Ryan?
Thanks so much for joining us all today. I really appreciate you taking the time. So as Chris mentioned, today's topic is health spending accounts, and really what we want to focus on is business owners and you, the advisor, and how you can use this as a tool to prospect going forward. So to start the presentation, I wanted to take a second just to highlight some of what we are hearing on the street from business owners. I'm sure this first comment is not something that's coming as a surprise. Now, the reality of business owners, certainly the small business owners, is they really are trying to attract quality people, and once they get them, they're struggling in some cases to figure out how to keep them. So naturally, compensation and the variety of compensation items that come into that picture are on their mind. The next layer, again, I don't think this is a surprise, but certainly in that small business space specifically, they're on a tight budget. And when it comes to the more old school traditional benefit thought process, that budget can get blown pretty quickly. The traditional benefit model is not rocket science. It's frankly, your premium is based on how much your people have claimed in the past. So with health spending accounts, one of the big benefits is the fact that the business owner is flipping that conversation around and they're taking control. They're dictating what they want to spend versus the other side with a traditional program, which is a more insurance-driven price. So what's in it for your clients? I mean, the high level here, a health spending account is simply a method of using company dollars to cover off things like personal, medical, and dental related expenses. One of the key perks to Benefits My Way specifically is that your clients or yourselves, if you decide to set up an account, you do not pay for anything that you don't use. So frankly, if you don't use the account, it won't cost you or your clients anything. For example, they might need it for a couple years in a row, and for some reason, 3 years down the line, they have a quiet year and they don't have any expenses on the books. Well, as a result, they don't pay a nickel in that year. The biggest perk and biggest selling feature of health spending accounts in general is that they are 100% tax deductible to the business as benefit premium, and they are also 100% tax-free to their employees. So for those folks out there that are used to talking to traditional benefits or to businesses that have put in place a traditional benefit program, they really can forget about those renewals and the increases that seem to come year after year and take back control and dictate their own budget. So for the purposes of today's presentation, we're going to give you an example. So we're going to talk about a business owner that knows January 1st, before they wake up, they've got about $5,000 in personal, medical, and dental related expenses for themselves, maybe for their spouse, and or for their children. So again, for the purposes of this presentation, the example here, we're using an individual business owner that has $100,000 in annual income and they reside in the province of Alberta. For those of you outside of Alberta, I would encourage you to check out benefitsmyway.ca, and under the resources drop-down menu, there's a savings calculator there that you can tinker with to play with the example for yourself. Okay, so for the purposes of this example, again, we're using that $5,000 medical expense amount. And for this business, they would have to pay themselves just shy of $8,000. Then they would have to pay the government, and that would then leave them with the $5,000 allotment to cover their medical and dental expenses. So in that situation, they obviously don't have a health spending account. So let's show you the smarter way to go. For an incorporated business owner that has a health spending account, things just got a lot more affordable. This now takes that $5,000 expense, adds on the Custom Care's 10% admin fee plus applicable taxes in Alberta, and now the total expense to the business is $5,525, or savings of about $2,300. We haven't changed anything. We haven't asked that business owner to spend another nickel that they haven't used or experienced in the past. So we're just showing them how to be smarter with that same $5,000. So you might be asking yourselves, okay, benefits my way, like the idea of the tax savings, but is it right for some of my accounts? First things first, we have to ask a couple of qualifying questions to see if they would be a fit for benefits my way. The first question for us is the business incorporated? So for Custom Care and Benefits My Way, we do require incorporated clients. I'm happy to say we've just broached the 9,000 clients on the books. But there are sole proprietors out there seeking options, and frankly, there are options out there, but for the purposes of our product and our presentation, we're going to focus on the incorporated side. The second piece might sound intuitive, but the key here is that business owner actively engaged in operating their business on a day-to-day basis? So I say intuitive because, of course, what business owner isn't involved on a day-to-day basis? But when it comes to things like silent partners, board of directors, or people that are loosely involved with the business, those individuals would not qualify for a health spending account. So it's very important that we know the business owner is engaged on a day-to-day basis. Then the question is really simple. So if we've said, yes, they're incorporated, yes, they're actively engaged, the next question is simple. What are their expenses? What does that business owner incur annually? And if they do take some time to do a little quick math in their head, they start calculating up how much time their kids spend at the dentist, a few extra massages or physio visits throughout the year, and any medications, they're going to quickly come to a number that they know they're going to be spending whether they like it or not. Here's some common eligible expenses. The most common ones that we adjudicate would be things like prescription drugs, vision care, dental, chiropractic, massage, physiotherapy. Orthodontics is a big one. So for those out there that have children about to go down the path of braces, that would fall under that category. And to be clear, it's not us that dictates what the eligible expenses are. So as you see here on this slide, if you just search the CRA's eligible medical expense list, they're the ones that are determining what we can actually deduct through these health spending accounts. So how does it work? So this is Carter. Carter owns ABC Corp. Carter has to go to the dentist, so he's on the hook for $500 personally that he pays for with his credit card. Carter's company, ABC Corp, then funds the HSA to cover the cost of the expense, plus the 10% admin fee, plus applicable taxes. From there, Carter submits his $500 receipt to his health spending account. There's a couple of ways he can do that. He can download the mobile app and just snap a quick picture of that receipt, or if he prefers to pop on to the member portal, he can certainly do that there as well. Now, Carter gets reimbursed his $500 personally, which is 100% tax-free to Carter, and the company that covered the $500 contribution to a health spending account, which is deemed benefit premium, plus the 10% admin fee and applicable taxes, is all now deductible to ABC Corp. So very quickly, we've just given you an example. Now, if you're having this conversation with a business owner, I'm anticipating you're going to hear one of a few objections, so we want to prepare you right out of the gates for those. The one we hear most often is, yeah, it sounds great, but I already have coverage through my spouse. And my reaction to that is, that's fantastic. Great, this business owner's obviously got coverage in place to cover off, hopefully, the catastrophic type issues. But what they might not know is that majority of benefit plans, traditional benefit plans, do not offer 100% coverage. So it's very typical that you would see a benefit plan covering 80% of medical expenses, maybe 70% of dental, or maybe their massage caps out at $500. Whatever the case, chances are really good that that business owner is still incurring something out of pocket along the way. The second one we hear a little less often, but certainly I've heard it a handful of times even this year. The business owner says, my accountant just takes advantage of the medical tax credit when we're doing my income taxes. Again, that's fine and great. I don't claim to be an accountant, but my understanding is the MTC allows you to deduct about 25% of those eligible expenses after you've satisfied a deductible. So From my perspective, the answer is pretty clear. If we use a health spending account, we can deduct 100% of those expenses through the business, and we don't even have to worry about the MTC. Number 3 here is probably one of my favorites. Fortunately, we don't hear it too often, and although I still hear it more than I care to admit, and that's a business owner saying that, we just reimburse our employees, they bring in their receipts, and we'll pay them back for whatever that expense might be. That's not technically kosher when it comes to the accounting principles. Frankly, in every case that I've run into that has said this is how they do it, they're not accounting for it properly. So when you give an employee a cash or some kind of compensation to cover off that expense without utilizing a proper third-party adjudication system, there's no formal plan in place. So it's not benefit premium, meaning it's not a deductible expense, as well as the money that's being given to that employee now has to be treated as a taxable benefit. There's one other maybe less obvious issue with this setting, and really it boils down to privacy. Maybe I have an expense that I'm not super comfy with the idea of bringing that receipt forward. Maybe I'm dealing with a medication or something's going on in my life or maybe my family's life. I probably don't want to bring that information to my employer. With a health spending account company like Benefits My Way and Custom Care, that is completely removed from the equation. So an employer is entitled to see balances, to have an understanding of the utilization, but they will never actually see what the receipts are for. So that information is totally private to those individual employees. Okay, and the fourth one, which you probably run into quite frequently, is these businesses that say, I already have a benefit plan, so we've got our coverage in place. Again, very similar to the first point. That's great. It's wonderful that they have coverage. Hopefully it's extensive. The key here, though, is most business owners still don't understand that those benefit plans don't cover 100%. And if those business owners have any additional expenses outside of those benefit plans, they can still use a health spending account, and it doesn't have to be with the same provider to help cover off those expenses. So in both 1 and 4, great opportunity to put in place a small health spending account, even if it's just as a top-up program. So when considering Benefits My Way, I'm sure the one thing everybody wants to know, the cost. You've heard me talk about the 10% admin fee plus applicable taxes. That really is it outside of a one-time $295 setup fee. That one-time fee is per company, not per employee. So it's not per year. So one-time $295 to set up the program. And then from there, the company is only charged 10% as an admin fee plus taxes at the time of claim. So if the owner or employees don't use the accounts, they never actually have to pay for it. If you're interested in adding ancillary product or additional insurables, the health spending account is the foundation to the program, so it must be in place before any of these options become available. But certainly you're welcome to explore these at benefitsmyway.ca. I will highlight that the travel and major medical package is the most common additional product that's added once an HSA is implemented. That comes with $1 million out-of-country coverage, as well as a catastrophic medical coverage for $125,000 for things like medications, hospital, ambulatory care, physiotherapy, etc. And that is per incident. There's a $2,500 deductible that needs to be satisfied first. And in that, the health spending account can actually be used to cover off that deductible. And forgive me, so that's $125,000 over a 2-year period. It accumulates to $250,000 per incident. Again, if you want to visit the website there, you can get the specific details on all of the coverages. So for us, this is simple. Obviously, we want to work with as many advisors as possible, and we want to help you create informed and happy clients, and we'd really love for you to become a client as well. Frankly, the Benefits My Way Health Spending Account program is a fantastic door opener. It's an opportunity for you to provide immediate value to these business owners. We're not kidding ourselves. We know you're not going to get filthy rich off selling health spending accounts. That said, however, health spending accounts is a really simple conversation to add a lot of value. And please stop me and tell me if you know a single small business owner that doesn't want to figure out a way to save more on taxes. So you can add a lot of quick value, and you're also going to engage in a personal finances conversation as a result, which will hopefully open the door to additional sales for you. So introduce Benefits My Way to your clients, but what's in it for you? So when it comes to selling these accounts, of that $295, there's $250 of commission built into that. There is also 3% commission built in to the 10% admin fee. Okay, so that's how you're compensated on the health spending accounts. In addition to that, if you add any of the ancillary products on top of the health spending account, you can see here there's a variety of additional ways to be compensated as well. Now, we want to help support you in a variety of ways. Obviously, we want you to be compensated. We want you to know that you've got us as a resource to help you with your clients. We also want to offer you the opportunity to co-brand some of your material, some of our materials, to really make this your own. So we've got some options for marketing material as well as a custom landing page that we're more than happy to develop for you. We will gladly throw your logo on this information, on this landing page and get you set up. You can link your own website to the landing page as well. And if any web traffic comes from your website to this landing page, we have the capability to track that individual. And as a result, if they buy on the website without even having ever talked to you, we're more than capable of ensuring you're compensated for that account. So really, health spending accounts get you access to ongoing revenue. Now, that's the really nice part about benefits in general. It is repetitive, especially with health spending accounts. You don't have to be involved on a regular basis. Whenever claims come in, you're going to get a nice little trail on that. We do have absolutely leading edge technology with our mobile app. Very few of our competitors have that capability, and we are ready and willing to help in any way we can to help you generate additional business. Health spending accounts, I can't say it enough. If you show a business owner how to save a few dollars in taxes on something they're already doing, and I think that's the key, this is not asking somebody to buy a new program or to invest in something different. We're just showing them how to be smarter with their health spending account. So if you're interested in any of that co-branded material or the affiliate program with the landing page, just check out our sign-up information. Once you get that over to us, we will get a response back to you quickly, and we can usually have those landing pages set up within 2 weeks. As I mentioned earlier, if your client happens to pop on your website and they see this, or you direct the traffic to your website to go and sign up, I can also let you all know that there is no paperwork here, so everything is done digitally. But if your clients go to the Benefits My Way landing page without even having talked to you, we will ensure you're compensated accordingly. Now, I've talked a lot about the business owners, and as I'm quite confident that a good chunk of you on the phone are likely business owners yourselves. And we would encourage you to set up a health spending account and check out the Custom Care's Benefits My Way program. We want you to see exactly what your clients are going to experience. We want you to benefit from the tax reduction yourselves. We'll waive the $295 setup fee for you to get started, so it's totally free for you to set up. We're also going to take the commission off that admin fee for advisors. There's no sense you paying yourself on your own medical expenses. So your admin fee is only 7%. And this is a great way for you to take advantage of the program, take advantage of tax deductions, experience it for yourself, and there is no risk. Because there's no setup fee, you set this thing up for free. If you're not happy or you don't use it for any particular reason, we'd love the feedback, but it won't cost you anything. Now, we are going to have another webinar in January just to speak further to some of the legislation updates that have been coming down the chute. Real quick, high level, I know there's some folks out there that might be curious about the whole health and welfare trusts and how they're treated from a tax perspective. I can confirm for you that the Benefits My Way program is a health spending account, a healthcare spending account, not a health and welfare trust. They are two very different vehicles. Essentially, health spending accounts are administration services only. You are compensating an organization like Custom Care to adjudicate claims to make it a legitimate expense, a deductible benefit premium for a business. The health and welfare trusts, again, just on a really high level, was traditionally used as a means for business owners to help get money out of their business to target medical related expenses long after they've sold their company. So that's one of the issues that the Canada Revenue Agency had with health and welfare trusts. There was far too much money flowing out into these accounts, and it would continuously roll over year after year. With a health spending account, it's very different because you don't have that unlimited rollover capability. Most plans don't allow any rollover. We do allow the option to roll over balances for 1 year only, and if they're not used, they would lose those credits. So you have a lead. You've talked to a business owner. Now, what do we do next? You're welcome to contact Lisa McRae, and you will get her contact details emailed to you as well as the presentation after this. Lisa's fantastic, and she'd be more than happy to communicate with your clients and walk them through how to get set up. If you've got a client that feels savvy enough to go at it their own, it really is a very straightforward process. At benefitsmyway.ca in the upper right-hand corner, there's a Buy Now button with a couple of very quick, short steps. They can pay for the $295 setup fee with a credit card, set up their banking information, and away they go. So this really is very straightforward. If anyone's interested in having some more technical conversations around health spending accounts, please do take down my information. I'm more than happy to speak with anyone as well. And we'll do whatever we can to help you land a bunch of these health spending account clients. That's it for the webinar. Now, Chris, is there any questions out there?
Yeah, you do have a few. The first question was, is there a limit that you can put on partners considering that you are setting the amount for employees at a lower amount?
Great question. Okay, so a couple of different pieces of information I need to throw out here to answer that properly. So the key is you can set up a variety of classes within a particular account. So you might have an executive class, management class, all administration class. You can be creative with what those classes look like, and you can set up different amounts in each class as long as everyone in a given class is treated equally. So for an executive level class, our suggested mandate is to have a cap no more than 20% of their declared income from the business. The reason we use that number is, that's the number that we've used, that we've been given by our accounting resources as a comfort level. If I'm being perfectly honest, I know there's accounts out there that opt to go higher than that, but really that's our comfort level. We're not here to dictate that number or to challenge that number, because frankly, we're not going to inquire about someone's income levels. But it is important to know that the CRA's stance, like far too many things, is a bit of a gray area, and they deem it a reasonable amount. And that's where things can get a little sticky, because what's reasonable for one may be very different than someone else. So we use a 20% threshold for executive level.
Next question, Ryan, is how are employees enrolled?
Also a great question. So as part of the setup process, they will set up their business account, and at that time they can determine whether they want to have classes added or not. They can add their employees on the portal at the same time, and they'll actually insert the employee's email address, and each individual plan member will be contacted and given the opportunity to go sign into their own member portal and set up their dependents and view the additional information that's available there as well. So again, everything's digital.
Next question is, does the employer have to include all employees equally on the HSA?
Okay, fair enough. So the answer to that is not necessarily. It is important to know that they have to class to everyone. So, you might have all full-time employees that are going to participate and are going to get a level of health spending accounts. They're all going to get $1,500, but maybe your part-time class or your seasonal class are not going to get anything. So it's really important that they define what those classes look like, and for their own internal purposes, they also define classes that are not entitled to any benefits.
Next question is, do you provide a confirmation of coverage certificate, and do you pay dentist paramedical practitioners directly, or is this a reimbursement plan only?
Reimbursement plan only. And yes, coverages for the insurable programs, that is all policies set up with outside insurance companies. So depending on the policy that you select, we have insurers behind the scenes that are reinsuring those policies. So we would absolutely provide confirmation of coverage on that side.
Are claims strictly online, or can they be paper submitted?
At this time, it is strictly online.
The question comes in the form of a comment, Ryan, but so all I have to do is find an incorporated business owners who are interested in discussing this idea further, and I can hand them over to Lisa to do the rest? Do I have that right?
Essentially, that's correct. If you have a business owner that is ready to talk about a health spending account, we would be more than happy to talk to them on your behalf. And if they decide to sign up, you will be compensated in full.
The next two questions I'm going to combine because they are similar. Is in vitro fertilization covered, and what are eligible expenses?
Okay, for eligible expenses, I'm going to refer those folks back to the Canada Revenue Agency website. If you just throw in your search engine CRA eligible medical expense list, the website will populate and you can search for days of all the various things that are covered. And yes, my understanding is in vitro, a variety of services that come along with that would be covered.
HSAs have always been defined as employee plans. How much trouble with CRA in debating whether an owner is a legit employee for the plan have we encountered?
So this is really, again, this is going to tie into that gray area of the CRA's lack of guideline. The fact that they say a reasonable amount is the suspect dilemma. So if you put yourselves in the Canada Revenue Agency's shoes, really all they're trying to do is avoid a situation where someone's abusing the system and overutilizing a plan. So the key with health spending accounts and what makes them legitimate in the eyes of the CRA is there's caps. So we have a limited number throughout the year that an individual can claim against. So if it's 5,000, I set that for Jan 1. I now can't change that number until the anniversary or December 31st. All accounts on our end are calendar year. So that restriction is what makes the risk element legitimate in the eyes of an auditor. Now, again, that 20% threshold that we've acknowledged, that's our comfort zone. Anyone that we've ever had as a client that has stuck within that level has never had an issue, at least never had an issue that they've brought forward to our attention.
Couple of questions about sole proprietors.
Okay.
Are they available? Is this plan available for sole proprietors?
So I will say that for advisors, for sole proprietor advisors with at least one arm's length employee, we will make an exception. There are additional restrictions and limits to what a sole proprietor can use health spending accounts for, but that's the extent of our restriction. So we don't any longer sell to sole proprietors for a variety of reasons. That's a business decision that we've made. The biggest piece of that puzzle is because of those limits, there's such small accounts, and because of that, it becomes an administrative headache in most cases. So to be perfectly transparent, there's just not enough revenue in it to make it a legitimate offering.
How are these HSAs funded if a new plan is set up and immediately expenses are submitted?
So the way we structure things, we set up accounts based on the first of the month in which the setup is acknowledged. So if they set up, they would be able to deposit funds into the health spending account immediately, and as a result, they could then claim against that account right away as well.
Ryan, can I just jump in for a moment about that, the funding of the claims?
Please do.
All right, so there's two options when they're setting up an online claims account. One is to put a float in the account immediately so that there's money for employees to draw off of. If a company decides to use the pay-as-you-go method and an employee submits a claim online, it is checked by one of our claim adjudicators, and then the administrator of the program is sent an immediate email letting them know that there's claims impending, for which then they can log into their admin account and then fund the claim immediately.
Just to add to that quickly, so obviously claims will not be reimbursed unless funds are in the account.
Next question. Can DSAI premiums paid by employee be run through your HSA?
Tammy, you want to answer that one?
Yes, if an employee has taken up the DSAI, or if the employer has set it up that it's a payroll deduction for the employees can put through the DSAI because it's considered an extended health and dental benefit, which is claimable under the HSA. Things like life insurance and CI would not be because there's a tax value, which means it'd be taxable at time of claiming.
And I guess the second part to that question, Tammy, is can employers deduct employees' DSAI premiums if they choose to pay on their behalf?
Yes, if the company is paying the DSAI premiums on behalf of the employees, they are deductible business expenses.
Is the full amount with the 10% plus applicable taxes that the employer can deduct from his expenses, or without the fees and the taxes?
Total amount.
Can this be offered to owners only if they supplement this plan with a business that has a traditional plan with a different company?
Yes, it can, as long as it's an incorporated business.
Can this be implemented on a holding company?
Tammy, do you want to field that one?
Yeah, so it really depends on how the holding company is set up. If there is an active company that is funneling money into the holding company, then no, unless the active company is also an HSA plan member as well. What CRA has made very clear is that you can't use a holding company for the shareholders to take part in a benefits program that isn't being offered to the active employees of the active company. If you have a holding company that legitimately is the only company that the business owner has, he's still actively engaged in running the business, there's active income coming into the company, and he's being paid active income, then yes, that holding company would then qualify.
Does the business owner keep a reserve amount for employees, or do they pay when a claim comes through?
So that's part of the example or the options that Tammy explained. So yes, a reserve can be established for which the employees can then claim against, or if the employer prefers to fund it as they go, then we will notify them that a claim has been submitted, and as a result, they have to go in and add funds to the account in order for us to reimburse the employee.
For business owners who are incorporated, is the 20% of company revenue or 20% of the T4 income?
T4 income.
Is there a maximum HSA limit?
Again, I think the 20% threshold of declared income is the key. We on average, we would see our business owners setting up accounts in the neighborhood of $4,000 to $5,000. That's also why we set up the example the way we did. For employees, it would be less. So just to give you a rough idea of what those numbers are, but we also have business owners that are significantly above that. So there's not technically a cap, but again, because of the gray area of how the CRA defines this, the 20% threshold is where we would recommend you stay within.
And the next question is, how do I sign up for an account for my incorporated business as a broker?
That's a great question. You are welcome to contact either Lisa, or if you wish to go to benefitsmyway.ca and click buy now, you can get it started right away. We're hoping you all will.
You said employer doesn't see what employee claims, but can the employer know how much each employee has claimed?
Yes, absolutely. They have the ability to see balances remaining by employee, but as you've stated there, for privacy reasons, we do not share what has been claimed. But you can be assured that if it's on that CRA eligible list, our team will have human eyes on every single claim and ensure that it is an eligible expense on that list.
What is DSAI?
Great question. That is the Diagnostics and Specialist Access Insurance. Again, I'd encourage you to go to benefitsmyway.ca and check out the add-ons drop-down menu. That will give you some additional information on exactly what that program does.
Can the premium for the traditional benefit plan be deducted through this plan?
So I guess we're assuming that the employee is paying the premium. It probably wouldn't make any sense for the employer that's paying premium to then deduct through an HSA. But Tammy, I'm not sure about that one for the health and dental premium.
Sure. So any premiums are being paid personally by an employee or a business owner can be put through the HSA. Only the health and dental portion, though. So life insurance, long-term disability cannot. But the key thing is to remember that it does need to be paid personally. So if you have a business owner and the company is paying those premiums on his behalf, then no, because it's already being 100% tax deducted by the company. But personal, yes, for sure. And then the difference of what's not being covered by the traditional program as well.
So for example, Tammy, if my spouse has a traditional plan, is paying 50% of the health and dental premium for their program, I do not have a traditional plan, but I have a health spending account, would we be able to deduct my spouse's premium through my health spending account?
Absolutely. And something to also keep in mind when you're setting up coordination of benefits with your spouse, it is imperative that your spouse does not list that their partner has another benefits provider, because an HSA is not a traditional benefits provider. It is a self-insured program by a business owner. So all of the medical expenses need to go through the insured plan first and then use the HSA as a top-up.
Great point.
Just to confirm, this circles back to the question about partners on the plan. I can just have partners on the plan and not have employees. I thought every employee had to have a place, but at different classes.
So I guess if we're talking about partners, they all have to be actively engaged with the business. They can't be silent partners or investors. And as far as their staff is concerned, yes, it's advisable that you have an additional layer, whether that be everyone or another tier of employees that are participating on some level. The key here is if in the event a client was audited, the CRA does not want a program to be viewed as a shareholder benefit. So if no employees are receiving benefits, but the 3 shareholders are getting health spending accounts for just themselves, that might not look great in the eyes of the auditor. Although, I've had instances where that's gone through and been all right. So my opinion in this case is you want to have a second layer of employees participating at some level.
And I do agree to that too, Ryan. I do feel like, especially now there's been so many changes with CRA and they're really starting to crack down on some of these plans that aren't being facilitated properly, that, all of the business owners that are added to the plan, they do need to be actively engaged, not passive shareholders. And adding in your full-time staff is the best way to guarantee that when you get audited by CRA, that there'll be no issues at time of audit.
Just again, to add to that, the fact that executives are going to receive, likely much higher account balances, that's normal. If you think about the traditional line of benefit planning, it's very common to see executive or management classes that have much higher coverage than the rest of the staff. So that's okay in the health spending account world too. The key is just not making it a pure shareholder benefit.
Can critical illness premiums be claimed?
They cannot.
When my plan was originally set up as an advisor, I had to choose an additional coverage such as CI. Is this still the case?
Ryan, I'll handle that question. So I'm assuming that when that plan was originally started that you were a sole proprietor. Sole proprietors needed to take an element of risk with the same company that held their HSA. So if you're an incorporated company, you do not have to take an insured component. If you were a sole proprietor, that is why you needed to take that element of risk, and that would have been the plan that you chose to take at the time.
Can a business owner's dependent parents be covered?
If they are somehow involved in the business as an employee, they would not qualify as a dependent under the employee's account.
So, Ryan, just to interject there. So, that is a really sticky thing with CRA. So we have had cases where we've gone to CRA for clarification on parents being covered. The only way CRA will allow a parent to be covered under a dependent as an HSA if that parent is solely dependent on the employee for 100% of their care. Or if the parent is living in an assisted living facility where the employee is actually paying those fees. Again, they have to be living with the parent or in a special care facility, and there has to be paperwork filled out by doctors. So technically, yes, it can, but it's a case-by-case basis that needs to come into our client care team for evaluation.
Is there a recommendation for employee waiting period?
For that, I think it varies based on what the business is trying to achieve. I mean, it's really common to see 3 months, 6 months, even a year. It's also common to see companies that want to reward loyalty, so they might start you out at a certain level, $1,000 health spending account, and after you've been with them for a couple of years, they increase it to $2,000. So there's some creativity in what an employer can do there. The key, again, is just treating people equally.
If the owner is remunerated with dividends but is actively involved in the business, can they participate in the HSA plan?
Tammy, you want to field that one?
Sure. It's a gray area with CRA. The only 100% way to guarantee that a business owner will fly through with flying colors at an audit if they are taking a portion of T4 income, because that solidifies them as an employee. There have been cases where business owners do take dividend. They can prove that they're actively engaged in the day-to-day operations, and at the time the auditor is completely fine with them using the HSA. So, it really is it's really up to the business owner. A CRA bulletin was released in July of this past year in regards to sole proprietors qualifying, not qualifying. In one of the lines in this bulletin, it did state that a business owner does have to be taking T4 income. So for that reason, we are really recommending that all business owners not challenge that with CRA and to take a small portion to make sure that they're satisfying that requirement.
That is all the questions that we have right now.
Thanks, Chris. And thank you so much to everybody that stuck around for the extra time and the questions. And we hope to hear from all of you soon to set up your own health spending accounts. And as mentioned earlier, we will make sure that you get the content from this presentation, and a recording will also be posted. All the best, everyone. Thanks again.
So, Ryan, just 1 second. Christy's asked another question. So, yes, the 20% of the dividend income can be included in the total amount that the employer is taking to come up with their benefit limits. So if they were taking $50,000 in T4 and $50,000 in dividend income, yes, we could use the 20% of the $100,000 that they're pulling from the company.
We've also got one more question asking about whether an unincorporated broker can be covered.
The only way that an unincorporated broker can be covered is if they have one at arm's length employee. So you do need to have one employee that you're paying to be included in the program.
And that's all the questions we have. Again. Just to let everyone know, the recording will be made available to you all via email. And if you do have any additional questions, Lisa's email is up on the screen. You're also welcome to get in touch with me. I'm the one who sent you the initial meeting link in the first place, and I can make sure it gets forwarded on to the right people. Thank you again for joining us today, and thanks, Ryan and Tammy.